What do you see as the significance of Meta coming to market?
Well, listen, being a bond guy, it's sometimes we're living in a bizarro world. Oftentimes, bad news is good news. Higher spreads means lower prices. The floodgates have started to open. Now that we're worried more about a recession and a real economic slowdown, the Fed might be backing off. So what happens? Rates rally, spreads rally, and the cost of capital now for high-quality investment-grade issuers has fallen about 100 basis points. And that's why you've seen these floodgates open for names like Apple, Intel, IBM, and finally Meta.
It is interesting, Robert, when you consider the fact that Meta has about $40 billion of cash and cash equivalents. You referenced Apple. It's a lot closer to $180 billion, and yet they are taking advantage, to your point, of what the bond market offers them right now. Is there a concern, though, as things weaken, that those cash flows, which are pretty mighty in tech, start to weaken a little bit more if you're making a decision to pull the trigger on a credit deal?
Not at all. I actually think there's nothing but excitement. The demand for these deals have driven pricing much lower than initial price talk. In particular, somebody like Meta that has zero debt, nobody has exposure. This is not like an equity where their value has fallen by 50%. Everyone wants exposure to high quality cash flow generating assets. And Meta, even though they're going to be spending a ton of money this year, free cash flow is still likely to hit $20 billion. I think this is exactly the type of name people want when they're worried about a macroeconomic slowdown.
And this sort of brings us back to the theme. I think it was you when we interviewed you about Apple. You said $5.5 billion, why not more? I mean, when you think about the ability for the company not only to service debt, but to take advantage of still relatively low yields, as you brought in smartly, the weighted average cost of capital, the ability to raise debt. So is this really the appropriate use of cash when we think about this environment with the WACC, the appropriate use of cash for these companies?
Yeah, listen, Apple's a little bit of a different story. They have $120 billion of debt outstanding already. Meta has nothing. The effective cost of debt capital after tax is zero for names like this. So for Meta, it's not why not more, it's why haven't they done it so far? And quite frankly, they haven't really needed to. But with revenues flattening out, with cash flow going down so much, I think they need to build up this excess kitty so they can continue to pour more money into their metaverse-style spending. If you think about it, Apple is looking to go net cash neutral, i.e. the same amount of cash as they have with debt. Meta's got $40 billion of cash, zero debt. They're probably going to raise $10 or $12 billion today. I think over the next 12 to 36 months, that number could go to 25, 35, maybe even 40.
And Robert, just to wrap things up, for credit investors, in terms of where this money ultimately is spent, whether it's on acquisitions or operations or maybe shareholder-friendly things like stock buybacks, is there a lot of interest or concern among the credit investors on how actually the money gets used from these deals?
Well, listen, bondholders are concerned about everything all the time, every single day. But when it comes to Meta or Apple or Alphabet or even in Amazon, we sort of all know that they're generating so much excess free cash. The vast majority of that money is going to go to shareholders. So the question just is, on an absolute basis, how much flexibility they have. When you're just looking purely at leverage, if Meta put on $50 billion of debt on their balance sheet, they'd only have leverage of 1 times. So let's not joke. We're not making any pretexts. Meta's not buying anybody. The government will not allow them to do any M&A. From my perspective, we talked the other day about maybe Apple would love to buy a Netflix. I just don't think that can happen from a government standpoint. So what's going to happen is they're going to use the money for share buybacks, and I don't think creditors really care. And quite frankly, the rating agencies don't care, and that's how you end up getting a AA rating.